Hello, everybody. My name is Bob Klefsis. I'm president of All-Star Financial. This is the All-Star Financial Q3 2018 webinar. Our newsletter and webinar are entitled Trade Tensions Lead to a Gap in Returns Across the Globe. Last year we had global synchronized growth. This year not so much, and we'll talk about that. Bob's Corner just wants to thank you. We've had great growth spurred here over the last 5 years, gone from 6 team members to 12. And we want to thank our clients for making that happen. Our first annual client celebration was a success, I believe, at Minikata. I want to put on your calendar September 13th, 2019 for our second one. We raised over $5,000. I think it was $5,500 for ACE's Washburn Center for Children and my dad's MS. So great evening, and we'd love to have you join us next year if you didn't this year. Market overview, real quick. Trade tensions obviously have created a lot of uncertainty. 245 billion in imports that have been affected by these concerns and tariffs being imposed. The tension obviously has rallied the domestic market, but obviously hurt the international markets, particularly emerging markets overseas. Appears to have more fear of the uncertainty of what these tariffs bring as far as slower growth. And the international markets are also facing headwinds that the dollar will continue to strengthen with these tariffs the way they are. So market overview, U.S. market and the growth that we're seeing in the S&P 500 year over year for Q2 was almost 25%. Q3 is estimated earnings at about 17 to 20. Next year it's down to something at 7 to 10 range, but still awfully doggone good. The amazing thing is that we've got 5 stocks, the Facebook, Amazon, Netflix, Google stocks are up 37%. Almost 60% of the total return of the S&P 500 is with 5 stocks. Kind of scary. We're also looking at a 10-year anniversary if the bull market hits March 2019 before it corrects. So finding the right balance between growth and diversification on the income side and capital preservation is really key for us. When we speak about the U.S. economy, it's still strong, 111 months of growth. Although it's been very tepid growth, only about 16% growth over this 10-year time period. Typically it's 40 to 50%. Real GDP is now starting to pick up at about a 4.2% pace for the third quarter. Estimate about 3% for the total year. Fed increased interest rates again for the 8th time in September at 2.25%. And then the CPI, which has gradually gone up here for the 5th consecutive month, raises concerns of inflation, right? So we've got strong job market, we've got rising commodity prices and trade ramifications that are probably going to tell the difference. So looking ahead, Fed's policy, they removed the term remains accommodative, so that kind of scared the market a little bit. Consensus is that interest rates might go up another 3 times in 2019, 2020, maybe once. I don't think so. I think it's going to be maybe 2 and done. But the Fed's positioning themselves to slow the economy to keep the inflation in check. I hope they just don't do it too much. On the bond side of the world, we're seeing a significant flattening of the yield curve. We see the margins from 10 to 2 years very, very low right now, less than 25 basis points, significantly greater normally. So that indication of the flattening of the yield curve where short rates go up and long rates come down is about 12 to 18 months from now is a recession. So hopefully that doesn't happen. That, as a result, has hurt the bond index returns, actually at a slight positive this quarter, but for the year, the aggregate is negative 1.6. High yields have outperformed other domestic bonds with a gain of 2.4 for the quarter, 2.5 for the year. Global bonds are down a little bit for the Q3 and a little bit more for year to date, 2.3. Most of that has been the dollar and the strengthening of the dollar that's hurt the global bonds. Our portfolio, however, we're very proud that we made 1.2% during the period. So thanks to our floating rate and our high yield exposure, that allowed us to have a positive outcome when the 10-year government bonds are down, 3.5%, 4%. So good time to be in the market in the third quarter. Fourth quarter, bond-wise, we think we're going to make some tactical decisions. We're going to keep the floating rate. We're going to add a new core multi-sector, take away a little bit of the international things because of the trade talks and the headwinds there, and add some short to intermediate term government exposure in case we do have a downturn sooner than later. Speaking about that downturn, we've had domestic stocks right now at setting all-time highs again in September. I think there's into the 40s, the number of all-time highs that it's set. And that reset of earnings that happened because of the tax reform has been really, really good. Growth stocks have outpaced value significantly by almost 16%. Growth index here is up about 8.88 compared to the value index of 5.39 just this year. Small caps have underperformed large caps in the quarter. For the year, they're about the same. S&P, again, technology composition of S&P and the consumer discretionary were up over 20.6%. Healthcare did a nice job at 14% positive, 16 for the year. We still had some laggards there in the real estate and financials and materials. So when we look ahead, stock valuations remain a concern. Even though we're at 16.8x multiple, and down from 26 9 months ago, that was mostly due to the tax benefit of our tax structure. Trade wars remain a concern. They could result in higher inflation with rising interest rates to make the equity markets even more volatile. Global markets were not in sync to the domestic markets this year. We're seeing a lot of the same thing that we saw in 2015 and 2016, where they were undervalued, but certain things kept them below their value. China was one of the ones to get hurt, probably the worst, negative 7.5 this last quarter, where most emerging markets were down only about 1%. Year to date, they're down 9 versus emerging markets in general, less than 8. Developed markets in Europe, a nice positive gain, 0.8%, 3.68 in Japan, even better. So they're thinking, Europe and Japan might be the benefactors of this trade imbalance or trade talk and tariffs. So when we look at the international exposure that we have, it declined about 2.6%, basically because we had so much in the emerging side of the world, but we are still committed to the emergings. It's a long-term cycle observation. Their demographics haven't changed. Their PE ratios, how cheap they are, haven't changed. So we're going to basically underperform here for the shorter time period to outperform over the long term. Global markets, again, looking forward, we have that optimism that carried forward into the first 9 days of this year, synchronized growth, and that went away with all the trade talks and concerns there, created a lot of market volatility. But we know that the fundamental valuations do bode well for internationals, both on the international emerging market side. PE ratios relative to the domestic market are really good, as you can see. So I'd much rather put my money into something that's at a 12.9 multiple times earning rather than a 16.8. So much cheaper. And in summary, what we want to look at is that, hey, the fears of trade war have really ruled Q3. Strong corporate earnings helped invigorate the U.S. market. That in large part was due to the tax changes. Fundamentals in Europe and Asia are strong, and they may be getting stronger as a consequence to the tariff negotiations. So we find the valuations extremely compelling overseas, and we're going to stick there. The other thing that we want to talk about is that, there's currency movements that have a risk that we don't have necessarily domestically. We have inflation threats domestically, some overseas too, and rising interest rate environment domestically, not so much overseas yet. We just hope that the Fed doesn't tighten the interest rates too much to squelch the growth that we have, because stocks for the most part remain relatively positive growth-wise, projected out, but probably slower. When you look at international equities and bonds domestically, those are the two that have really a good story to tell. Domestically here, you can see the 331% growth since the bottoming of the market in 2009, where the international is only 115. Much better buy. When you look at the yield curve, you need to be on the right kind of bond scenario right now, because from 2013, short-term rates have risen, long-term rates have come down, and that's that flattening that we need to be concerned about. So just want to make sure and aware of everybody. Hey, fifth page, we have Restaurant of the Quarter, Alma. Great 5-star restaurant that gives you 3-course menus, a lot of seasonal stuff that's really nice. Pair them with a wine. I tried it out a couple weeks ago, really good. Recipe for the quarter would be the streusel apple bread from Ashley. And a quote that I found interesting is that, when everyone's moving forward together, success really takes care of itself. Quote by Henry Ford. That's really what we believe All-Star is doing for you. And we're really pulling on the same end of the rope and wanting to make sure that we take care of you. So success is basically a given. So thank you very much for your trust in the All-Star Financial team. Remember, our referral program can help you reduce your fee. Since we've started that, it's gone down from about 1% to 75 basis points. So we would love to be able to reduce your fee from a referral standpoint. And then please let us know if we can do anything for you. Get a hold of us. These are our team members and our telephone numbers. So for those of you who are clients, thank you for your trust. For those of you who are not, hopefully this gives you a little bit of an inkling of what All-Star Financial thinks is going through the rearview mirror and what's going to happen through the front windshield. Have a great day, guys, and we'll talk to you soon.